So continuing on our conversation about loan costs and how rate impacts and how other things impact the actual cost of the loans that we have. So mortgage are a mathematical equation. There are three variables that define the cost of a loan. One is our rate, our interest rate. Two is how we pay our note, how we pay our mortgage. Do we pay interest first, which most loans, they front load that interest cost right up front? Or do we pay principal first? The all-in-one loan pays principal first. Every deposit that you make, dollar for dollar, goes to reduce the principal balance of the loan. And then time. If you have a 15-year mortgage and a 30-year mortgage at the same interest rate, because you're paying it off in 15 years, the loan cost is always going to be lower on the shorter term loan on a traditional mortgage. So principal and time, how do we speed up how we pay off our mortgage, and how do we pay principal first with the all-in-one? Simply by making deposits into the all-in-one account reduces the total amount of interest paid or reduces the total loan cost and isn't as rate dependent. So I love this diagram here because to me, it really highlights how we can go ahead and pull off and pay less mortgage interest. Because it's not about interest rate, it's about interest dollars for most people. And the beautiful thing about an all-in-one loan versus a traditional mortgage that allows people to feel comfortable putting more principal down against the mortgage is because if they need it, they can pull it back out of the mortgage. Whereas if you paid additional down on a regular 30-year fixed rate mortgage, that principal paid is lost money. You can't access that additional capital again without taking out a different loan or a second loan. So this, I think, is a wonderful slide. If you have questions, give me a holler on this. But to me, this breaks down how we can drive down loan costs by paying principal first and shortening the time it takes to pay off our mortgage.